Hi, I'm here today with my good friend Jay Pelosky. Jay, good to see you. We go back decades. How you doing, my friend?
Good, George. Great to be with you. Happy New Year.
Happy New Year. Well, the world doesn't change just because its calendar changes, and I think both you and I hate those year ahead type things. So we're just going to kind of do a around the world survey of what's going on. Jay, for those of you who don't know him, has his own firm, TPW Advisory. He was the global markets, emerging market strategist for Morgan Stanley for many years. Jay and I go back decades. I know a few people who are as keen observer of the emerging markets and global macro scene as Jay. Jay, I don't want to blow up too much smoke here, but you really nailed it last year. You were looking for emerging markets to outperform, commodities to do well, et cetera, et cetera. And so here we are. Take a victory lap. You're entitled. Catch your breath, all right? But as you know, we're in a "what have you done for me lately" kind of a business. You're only as good as your last trade. So as we start the new year, Jay, what's top of mind for you? Is it the song remains the same?
Yeah, it's great to be with you, George. And yes, last year was actually, we have a 12-year track record and independently verified track record. And last year was the best year we've had in our what we call our global multi-asset model. And so, yeah, it was a great year. And this year started off with a bang. Obviously, it's only the 14th, but if you tried to enumerate the number of things that have happened in
Hey,
the last 2 weeks, you'd have a long list. And I think what it does for us is it just reinforces the importance of having a structure, a process, a framework if you're going to do global macro. I mean, I think that's the case in any point. If you're doing global work, if the world is your oyster, if you're doing macro or multi-asset work, the world is your oyster. And so to us, we're big believers in framework, process, and structure to allow us to pay attention to what's important and to ignore what is not. And so our framework has been the tripolar world. And as you point out, it's in the name TPW, Tripolar World Advisory. It's a thesis I developed now 15 years ago, arguing that regional integration in the three main poles of Europe, Asia, and the Americas was going to be the global operating system. This came out of the great financial crisis, which killed globalization, was reinforced by Brexit, which demonstrated that nationalism is not going to work. And so we think it gives us a leg up on many people because literally for the last 15 years, we've spent as much time thinking about Europe, about Asia, as we do about the Americas. And as we talked about just in the run up before we went live, most people haven't because for the last 15 years, the US was the dominant market. The second part of our work is what we call the process. And there, the process really focuses on our writing. We write every Friday, our Friday musings. And I've been writing, since the days of Morgan Stanley, right? As a sell side strategist at Morgan Stanley, we had to write every week. And so I've been writing weekly for, decades. And I think it really helps us stay current. It helps us stay on top of things. And we're available, by the way, on Substack at the Tripolar World. And then the third is structure. And we have structure through our model portfolio delivery service, where we offer a global multi-asset model and what we call our TPW 20, which is a thematic model focused on future innovation and alternative energy. And we feel really fortunate to have climate in our work that we call our global risk nexus, which is the spine of our monthly. So we write our musings 3 times a month and then a deep dive every month that looks at climate, economics, politics, policy, and markets. In that climate focus, in that thematic focus with our TPW 20 model, has really kept us on the front edge of the move into renewables, the drive from renewables into advanced manufacturing, the new focus on electric power and what that means for AI, all these things which we think are the cutting edge of global economic activity, we really feel fortunate that that's our focus. And then importantly, we express our portfolio views through ETFs. We only do ETFs. I think they're a fantastic vehicle for asset allocation. And I wrote my piece last week, my Friday musings last week, talking about kind of the juxtaposition and interplay between football and investing. And I pointed out that in college football today, there are 4,500 players in the college football portal who are looking to transfer. And I made the analogy that there are 4,300 US listed ETFs that a portfolio manager could.
4,300, Jay?
Yeah, that's a fact. That's an
So
actual
wait, so
number
so it's true.
from
You,
Bloomberg.
you know the fact that everyone throws around there's more ETFs than there are
Yes,
listed.
stocks.
It's actually true now, right?
Yes, it is indeed
That's
true.
crazy. Sorry to interrupt. Go ahead.
No, no. So I think so. But that's the opportunity and the challenge. If they're 4,300, how do you pick, which ones to pay attention to?
Right.
So as I said, for us, it's the tripolar world framework, which forces us to focus globally. It's writing every week, which forces us to, pick what's important, to stay current, to think forward. And then it's a structure of having actual model portfolios that are available to clients that we track. And so we know what is going on. And I should mention, I think importantly for folks, is that the vast bulk of my own personal investable assets are invested in the GMA model. So my clients and I eat the same cooking. I know exactly what the GMA and TPW 20 are doing because I own it. So talking about the start to the year, it's clearly been wild, but I think overarching, it's what we said when we wrote our 2026 outlook back in October. I like to get mine out early, is continuation. So the title was Newtonian Investing. And so we went back to Newton's first law of motion, which is that objects in motion tend to stay in motion unless they're knocked off course by a bigger object. And so we were making the point that global growth, as we see it, what we've been calling literally since 2023, a global growth long cycle is underway. And that's fueled, by the way, through joint fiscal and monetary stimulus, right? We're in a fiscal age, which is why sovereign long duration debt is very unattractive. And we are cutting interest rates, which is why financials have done so well. So, global growth long cycle, stimulated by fiscal and monetary policy, together with spending across the tripolar world on AI, defense, and climate, all of which drives growth, which supports earnings, which supports stocks. And the second thing that we think is in continuation, switching to markets, is a secular change in global equity leadership away from the US. As we noted, 15 years, '09 through 24, US outperformed the rest of the world. 2025 was the first year where non-US equities outperformed, led by emerging markets. And we think 2026 will be the second year, 2027 will be the third, et cetera. In large part because here's an interesting thing. You mentioned my start in the markets began in EM correctly, going back to 1990 and launching a Brazil fund for Morgan Stanley Asset Management. But for the first time in my career, I think you can make a case, George, that the macro fundamentals in EM are better than in DM. So if you think
Wait,
about,
wait, wait, wait. Say that again for everybody. Say that
yeah,
again.
the macro fundamentals
Right.
in EM, emerging markets, are better than those in DM or developed markets. And
Wow.
typically, of course, people think of developed markets, Europe, Japan, US, as where the better macro fundamentals lie. But
Yeah, those
today,
EMs historically, they've had some sketchy Banana Republic like stuff where like the prime minister starts like firing the head of the central bank and other stuff like that.
You're
Don't
not
spill
trying to
your
make an
beer, Jay.
analogy here, are you, George? I
We're
mean,
gonna get.
I mean, it sounds kind of like what I read in the New York Times this past week.
Exactly, exactly. Go ahead.
So, but that is the point. That's one of the points. So, but when you look actually at the numbers, so CPI lower in EM than in developed markets. Debt levels, debt to GDP levels, budget deficit levels, better in EM than in DM. Growth, of course, better in EM. That's typically the norm, China, India, et cetera, growing faster than US, Europe, and Japan. But earnings also forecasted to be better in EM over 2026 and 2027 than in DM. So I think we're literally in the very early stages of a massive change in leadership, in fundamentals, in growth, in macro that is not yet been demonstrated in things like valuation. So you have the DM that are still have premium valuation, especially the US, attached to it, and you have EM with you know record low, almost historical low relative valuation, and in some cases absolute valuation relative to their own history at a time when the two things don't match up. So, in other words, if you did a thought experiment and you put the macro fundamentals of EM down and you put down valuation levels, you would put the high valuation and the EM fundamentals together. But today you have the better fundamentals in EM and the massive discount in valuation.
So Jay, a couple things. If I could just jump in and catch your breath.
Yep. Yeah. Yeah.
So, and then my question to you is, and again, I'm reminded, don't ask a question you don't already the answer to. Could
Hmm.
you speak to positioning as well? I mean,
Yeah, the positioning is very similar, right? I mean,
yeah,
very underowned, both domestic as well as institutional investors, right? So, an example is China. China just had a record volume day, I think, on Monday, so a couple
right,
days ago.
right.
Record volume driven primarily by domestic investors. International investors, particularly US institutional investors, are virtually completely out of Chinese equities since the Trump
100%,
won. Yeah.
100%. And,
Right.
and so, and yeah, so, I was, when we were talking before we started filming, I was teasing, I was like, Jay, could we be embarking upon the golden age of EM?
Yeah, and I think that's exactly right. And people still have not really cottoned on to it. And and as we touched on, EM doubled the performance of the S&P last year.
I mean,
S&P was up
I'm old enough to,
16%,
yeah,
EM was up about 33%.
I'm old enough to remember when, and I'm getting a little bit ageist, so I can't remember exactly the years, when EM was all the rage.
Yeah.
And the problem is, as you rightly point out, the U.S. has sucked all the oxygen out of the room. You're saying there is life beyond the Mag 7, basically.
Yeah.
That now we're on to now for something different. So I really like the sound of what you're saying because fundamentals are changing, the valuation is right, the macro drivers are right. It's not just number go up, and the positioning's all wrong.
Yeah.
So what's
And the
not to like?
technicals, the last piece that I would add to
Yep.
that is the technicals are very, very supportive. You're seeing
Mm-hmm.
breakouts
Yep.
all over the place. So as we think about the world today, and we wrote our monthly, the December monthly, the title was Trump Embraces the Tripolar World. And we were kind of making a play on the Don Rowe Doctrine, which had come out in the
Road Doctor.
National.
Did you copyright that one? The
Yeah, oh,
Don.
no, it wasn't mine.
I
I'm
haven't
a
seen
good
that one. The
I
Don
pick
Road
up
Doctor.
things.
I'm gonna use that. I'll give you credit. Go on.
No, it's not for me, somebody else, but the Don Rowe Doctrine. It might have been Trump himself or somebody in his circle trying to, give him props, so to speak. But we basically did a deep dive on his national security strategy document, and which had come out in mid-December, I think. And, really the focus shifted completely from the US as kind of a global hegemon that had to protect against China and had to defend Europe, to a regional hegemon focused pretty much completely on the Western Hemisphere. I think it's a really useful exercise if you're a global investor or a global macro thinker or investor. One of the things we did was we leveraged AI and we compared the Trump document to the last three national security strategy documents of the three prior presidents. So Obama, Trump won, Biden, and then Trump this past December. And it's staggering how different this strategy document is. It really does make the case for the US to pull back and basically abandon its role as a global hegemon to focus on being a regional hegemon, which of course it already was and already is and will be for the foreseeable future. But it's really, and then of course you had the Venezuela decapitation, I guess, or whatever the term is for taking out Maduro. But in our view, the Trump approach, while it's right for the U.S. to focus more on the Americas as a way to build up its heft to compete with Asia and Europe, the approach is pretty much exactly wrong, right? So if you think about, tariffing Brazil, right? If there's one economy you want to kind of get tight with in South America, it's Brazil. It's the biggest, it's the most people, it's the biggest geography, it's the most endowed with commodities, et cetera, et cetera. And of course, what are we doing? We're tariffing it and ticking it off. Then you have the U.S., Canada, Mexico, the original NAFTA, which was the origin of our tripolar world thinking back 10 or 15 years ago. And what are we trying to do? We're basically, Trump just yesterday, I believe, declared it as irrelevant. And so, you're sending a signal to the Canadians and the Mexicans that they need to be thinking and looking elsewhere. So you really have Trump sending kind of multiple messages as we see it. So the message to China is that, hey, you can have your sphere. Asia's yours. Keep deepening your economic ties with Southeast Asia. And by the way, you're really smart to reduce dependence on any kind of imported fuels or commodities or technologies. Because, who knows, we may decide the next day to go after Iran and Iran's oil, right? We're going to take Venezuela's oil. So you don't want to be dependent on anything. So it's basically giving Asia to China and reinforcing China's efforts to become more independent. To Europe, it's saying, look, you need to depend on yourselves for your own defense. And so, what do we see happening? We see what's likely to be, according to Bloomberg, the biggest defense maker IPO in history coming
Really?
this week in Amsterdam. Yes, a Czech arms maker is expected to raise $1 billion in an IPO this week in Europe. And so that's the message to Europe. And then in the Americas, the message is, we're going to do whatever we want to whomever we want. So you guys need to find some big friends pretty fast. So where is the Prime Minister of Canada going this week? He's going to China. And what is he going to do? He's going to be talking about how to sell commodities and energy to China to hedge against Canada's exposure to the United States. And so, as we think about the world going forward, we're thinking about something we call a new growth model. And this new growth model is basically made up of three things. The first is cheap, renewable power as a competitive advantage. The second is a expanding labor force. You and I know, I mean, neither of us are economists, but we know that the only way to grow is to either grow your population or improve its productivity. And growing the population is easier than improving the productivity. And so renewable power, cheap renewable power, expanding labor force, and then focus the two of those things on becoming a production platform for AI and EVs and the climate shift. And so we have spent a lot of time over the last couple of months and made investments in a couple of countries that we think are examples of this. The first is Spain. Spain is a fascinating example, okay? Because over the last half a dozen or so years, they've really focused on expanding their renewable power capacity, leveraging the fact that it gets all that sun that Americans travel to Spain to enjoy. The Spanish have used it to become very competitive in terms of its power costs relative to the rest of Europe. Spain has also recognized, and here I think this is a crucial distinction that is not yet percolated through most people, but I think is coming very fast, which is the countries that understand that expanding their populations through either natural, birth and things of this nature, or, structured immigration are going to be the winners. Spain, for example, is going to welcome 1 million new citizens this year.
A
And that's
million?
out of a population of about 45 million
Wait,
people.
wait,
Just
wait, wait. A
imagine.
million out of 45 million? That's crazy.
And exactly. And that's because they understand the value of growing their population. And, many of these are Spanish speaking people from other parts of the world. But the combination of those couple of things, plus others as well, of course, is that Spain has been by far the best performing large economy in Europe for the last number of years. In 2025, as a result of that growth, it received a double upgrade from the bond rating agencies, and
Right.
the stock market was up over 60%.
Hey,
So,
let me interrupt you 1 second.
sure.
Just as a point of reference and contradistinction, if you look at demographics, even in the U.S., but like a lot of the European countries, in China. It's just Japan. The population has been going down for 3 years. Could you, like pretty much in all these developed countries, demographics are a huge negative now. Isn't that the case?
Well, this is the point. This is why the developed economy growth rates are 1% and 2%. Because if
Yeah.
you're not growing your population, and again, this is why the U.S. has been the U.S. was the best performing major economy out of COVID for two reasons, right? One, immigration, and two, fiscal stimulus, right? We
Right.
spent way more money than anybody else.
Right.
And
Right.
guess what? Now we have a budget deficit that
Oh,
this year is expected. The forecast for the IMF, I just looked at this yesterday. The forecast for the IMF for 2026 is for US budget deficit of 7.9%. Okay.
what?
So this is again an example of how,
7.9%?
yeah, budget deficit is a percent of
Oh,
GDP. So this is another example of how the macro fundamentals in the developed countries are deteriorating while they're improving in the emerging economies.
Jay, wasn't a narrative in the mainstream media only a few months ago that the extreme budget deficits were, that was kind of like a one-off with the U.S. and it was going to get better and blah blah blah. And so when you tell me 7.9%, because I remember people saying it peaked, it's going to be like 6. Now you're telling me 7.9. Uh, and that's, by the way, I presume it's before, God forbid, the Trump tariffs are repealed. All right.
Yeah, I don't know what the
Yeah, what
underlying
that's going to do,
assumptions
but
are. Just looked at the specific
7.9%. Oh
number.
my God, that's geez.
And so to get back on point a little bit, so Spain is an example of this new growth model. And then in the emerging countries, we're using Brazil. And Brazil, as an example, has some of the cleanest generation of any country, right? It's hydro, it's solar, it's wind. So their generation is as clean as almost any country in the world. It has an expanding labor force still, and it also has proximity to the United States. So here's two little data points, literally from the last month, that support this thesis. The first is ByteDance, right? The Chinese company behind TikTok, has committed to a $38 billion investment in an AI data center in the northeast of Brazil. Okay. And that's because northeast of Brazil, via submarine cables, has some of the best proximity and latency to the US East Coast of any location anywhere in the world. So Brazil beat out a number of other countries for that investment. A second data point, also from a Chinese company, is BYD, which has taken over the mantle from Tesla as the world's biggest EV maker, is doubling its production investment in Brazil. So Brazil is going to be the major production platform for BYD in South America. And what we're seeing, and it was even evident today in the China trade numbers, right? China's trade surplus, 1.2 trillion, blah, blah, blah. The reality is that they are selling the stuff that's really moving is the high value added stuff, which grew 20% year over year, and which includes EVs and solar panels and battery storage. And so China is supplying to the emerging economies kind of turn on solar and storage power facilities that are allowing them to leapfrog the developed economies. And so when you look at the top 10 countries, and this is again where our climate focus and our thematic focus has given us the insight because we're paying attention to this. You look at the top 10 countries for EV adoption, the bulk of them are now emerging markets. And so while the US, the juxtaposition between the US and China in this stuff is staggering. So China is moving forward and competing for the future, right? They're taking their dominance in renewables, they're leveraging it into advanced manufacturing, they're taking their power dominance, their electric power dominance. China is becoming what people are saying the first electro state to compete against our semiconductor quality advantage in AI. They're reducing the benefit of that semiconductor quality advantage by having cheaper power, which allows them to provide more compute at a more competitive price point. So now China is moving into what we call embodied AI, which is the digital AI and the physical robotics combining to drive autonomy, which is really the next kind of horizon theme for us is autonomy, autonomous vehicles, autonomous factories. And China has a huge advantage on this front, in large part because it is dominating the renewable space. The US, on the other hand, what's the US doing? The US is doubling down on fossil fuel,
Hey,
and not only fossil fuel, but the most expensive fossil fuel you can get in the world, which is Venezuelan sour heavy crude. And so when we think about where things are going, we're really very, very focused on what we see as a tremendous opportunity in China. So right now, to kind of wrap up into kind of thinking like where are we in the markets, we're really excited about EM, about commodities, and you pointed out nicely that we've been focused on them for some time, including pretty much all of last year, as well as thematics. And so the fundamental case for us is very simple, and we encapsulate it in this really cool phrase, which is the digital eats the physical. In other words,
I get that. The digital
you got to
eats the
get
physical.
digital eats the
And Don road
physical.
doctrine. I got it.
Exactly. So, and very simple, it means that without water, without silicon, without copper, without aluminum, you don't have any AI. Full stop. No AI. And since AI is existential, and everybody in the world, every region in the world is trying to develop AI, that's putting tremendous pressure on commodity demand, on demand for the physical. The second is that the technical cases for this is really compelling. And you and I know the old phrase, right? The bigger the base, the higher in space, right? And so if you look at commodities, it's been like a decade-long base building exercise. If you look at thematics, it's been you had the big surge in 21, the massive bear market down 60, 80% in 22, 23, 24, zombie years. You look at the charts, like a great way to spend a half an hour is to look at every thematic on a 5-year chart basis. And it's like up, down, flat, and then up a little bit. So the stuff is compelling to us. And so when we think about markets, we think about China. So we've been very overweight China for about 18 months now in tech, in biotech, and in large caps. And so we have two main points on China that well, three. We've talked about, their lead on renewables, push into advanced and embodied AI, et cetera. The second is we think China is going to be successful in defeating deflation, right? Which obviously would have a very positive impact on earnings and would push rates up. So we've been saying for some time now, about the last 5 or 6 months, that the single most important number in global macro land is the yield on the 10-year China government debt, because that will tell us whether or not China is being successful in
Right.
defeating deflation. And so right now, when we started talking about this, it was at 1.6%. It's now about 1.88. We expect it to get over 2%. The third major point for China is that we think President Trump and President Xi are going to demonstrate a rapprochement when Trump visits Beijing in the spring. And as part of that, he will signal that it's okay for U.S. institutions to own Chinese equities. And that will be a big driver to China. The second market that we like a lot in EM is Brazil. And in particular, in Latin America in general, Brazil in particular, we talked about the commodities, we talked about the renewables, and the third is rate cut, right? Brazil is way behind the rest of the world in cutting rates. Real rates in Brazil today are 10%. We think they're on the cusp of what's probably going to be 400 to 600 basis points, George, of rate cuts over the next 12 to 18 months. And that will still allow them to have real rates of 6 to 8%. The
So,
only other country that's even close is Turkey with about 7% real rates.
Jay, going back to what you talked earlier in the conversation, I just want to drill down on one point in particular about comparing markets. Okay. If you covered up the names of the countries, you have the US looking at a 7.9% budget deficit, current massive current account deficit. I forget the percentage is 4%, whatever it is. Growth rate of whatever. Real rates are de minimis. And then you look at Brazil, where the real rates are 10%.
And real.
Okay. With the trade situation and the budget situation in Brazil are, I don't know what the numbers are, but vastly superior to the U.S. And yet the valuation and the positioning, everyone's in the U.S. So it's like, yeah, hello.
Yeah, there. I mean, Brazil does have a challenge with its budget deficit.
Sure,
So let's be clear, it's not a perfectly,
sure.
beautiful story. But nonetheless, it's priced at far from a beautiful story. And by the way, today, new 52-week high in today's trading, ILF, which is the Latin American ETF. And then the third is the commodity sector, right, that we talked about.
Right,
So EM, commodities. And in the commodities, the history is very clear. Commodity bulls start with gold and precious metals. They then expand into industrial metals and finally get to oil and energy. And what also hit a new 52-week high today, George? XLE and XES. And I mean, the numbers there are just staggering. Energy represents like 2% of the S&P, maybe 4% of ACWI. It's just
right,
ridiculous.
right.
And so, we've been banging the table on energy for months and months. We have a very, very big overweight. in our global multi-asset model,
Mhm.
basically arguing that the bad news is all in the price. Every Wall Street firm was competing to have a lower 2026 Brent forecast price. All this talk of major inventory overhang. And look what happened. Markets love to, again, you and I know, markets love to screw the most people the most often.
Sure.
And boom, where are we today? WTI at 61, Brent at 66. And what's the best performing sector year to date? Okay, it's only a couple of weeks, but even going
Yep.
back the last couple
Yep.
of months,
Yep.
energy has been a great player. And then finally, to finish, and you've been super calm. I know you, George. I know you like to ask questions, so I really appreciate your
Jay,
being
you're on a roll. I'm not going
patient
to
for
interrupt you.
me.
Keep going.
Is the thematic space. And again, keep in mind, we have been managing a thematic focused model portfolio for the last 5 years. And it's been a very challenging ride from the run up to the collapse to the sideways and now back to some signs of life. But we are very constructive on renewables, on semiconductors, which we see as the pick and shovel. There's a whole new DRAM cycle working through, just beginning. People focus on AI and NVIDIA. What that's done is that no one can get the lower quality chips that go into everything else because the makers are so focused on the absolute high end. So semiconductors, very compelling. Defense, very compelling. Fintech, the grid, the whole electric grid, very compelling. Rare earths, autonomy, biotech. Um, they're just the idea that, I mean, one of the most oversold things that one can think of in the last 6 months is the Mag 7, right? Everybody talks about the Mag 7, Mag 7, Mag 7. The reality is that they've underperformed the other 493 since November. And if you even look at going back the full year of last year, Mag 7 as a basket massively underperformed EM, massively underperformed
So,
ACWI ex-US, massively underperformed most of the thematics I just laid out there. So to finish up, overweight equities in our global multi-asset model, deeply underweight fixed income, especially any long duration sovereign in the DM. Most of our fixed income exposure is actually in emerging markets, dollar and local currency. And we have a position in private credit that we took last fall when all the fear jumped in about Oracle and AI data centers. We think that's way overplayed. And then almost double weighted in commodities for all the reasons that we've talked about. I have the risk as well. You said to make sure I have a risk, I can talk about that, or we can wait until if you want to talk
yeah,
about the questions.
we'll just table that for a second. So, Jay, I just have to say, wow. Seriously. I mean, life is not linear. The opportunity set is always changing. You have clients, you're a public person, you have to sound intelligent, have something interesting to say. Sometimes they're not giving you too many good pitches to hit.
Yep.
Other times you can see the ball. It's as big as a grapefruit. It's like, give me the ball. All right. Just listening to you, I'm experiencing one of those seeing God moments where like Pelosky's on fire. Okay.
Yeah.
So am I right? Do I sense from you? I mean, again, it's not just what you are, your beliefs, but the confidence level, the conviction you have associated with those beliefs. Is this one? And look, there's no guarantee this is going to be right, but in terms of being a good pitch to hit, and therefore your conviction around your views, is this a pretty good constellation of circumstances that we have right now? In terms of, I think your conviction level goes up and down, the opportunity set goes up and down. Sounds like you're in the zone right now.
Yeah, I think that we've been really, as I mentioned, last year, 2025 was the best year that we've had in the last
Mm-hmm.
12 in
Mm-hmm.
terms of returns in our global multi-asset product and structure. So yes, to that point. And seeing the ball well, as you point out, I think is very accurate. Again, sometimes you have a really good view of the future, and sometimes you don't. And the downside, of course, as you pointed out, is that we know very well from our long experience and the gray hair that we both have, is that, there's only when you see the ball really well or see the markets in the future, that at some point, who knows when, you're gonna be very confused.
Don't let it go to your head, Jay. I don't think you're a Bulls fan, but back in the day with Jordan, remember that famous game? And it was against Utah in the playoffs where he put up, I think he hit 6 consecutive 3 pointers, and he turns around, he's coming down the court, he just looks at the camera, he goes, "Okay,"
Yeah,
it's like,
exactly.
oh, okay, but like right
Exactly.
there, you're nothing but net. So
Yeah.
like enjoy it for what it is. And by the way, I want to come back before we get into more questions. Jay mentioned earlier, you can find him on Substack, TPW Advisory. And I would just say from where I sit, and I have no commercial relationship with Jay, I'm just want to try to help people, especially for those of you that have index funds in the U.S. or all in a Mag 7 and you want to be diversified, get away from that. I think this is one of those times. And I think Jay really has the playbook here. I'm reminded, Jay, and you'll chuckle. I think this goes a little bit, probably predates you when you started, but you're old enough to remember when. Back in the late 80s, when Japan got up to 66% of EFA, the Europe Australia Far East Index, the non-US S&P, if you will. I think it's now only 10%, whatever. 66%. You had Japanese banks, on 10 times book on 100 PE, and had a huge asset bubble. Point being that Japan dominated EFA. And I can remember one manager, should remain nameless, you know who he is, who was bragging about, oh, we're double or triple weighted Hong Kong, which is like 1% of the index. It's like, who cares? You're zero in Japan, right? So when you get to a point in the cycle where the index is killing everybody, I mean, we know it's true overall that active managers as a group tend to underperform, but sometimes it's particularly acute because the cost of missing, the cost of not participating is just so high. And let's be honest, the U.S. has killed everything else, in particular U.S. tech, and rightfully so. It's not like the stocks haven't gone up for a great reason. You look, relative price follows relative earnings. Earnings have just killed everything else. But see, if I listen to you, and there's a question here, we're witnessing a changing of the guard, all right, and everyone's stuck with this massive overweight. I mean, the U.S. has basically sucked all the capital out of the rest of the world. And I can remember when Japan peaked finally, the last day of 1989. You could outperform EFA for the next few years by just having nothing in Japan and
Yeah.
indexing everything else. That's all you need to know.
Yeah.
And I sense it smells to me like you don't have nothing in the U.S. There are some commodity-related plays, some cyclicals, et cetera, some tech plays. But if you did nothing but underweight the U.S. and underweight, certain parts of the Mag 7, whatever, and overweighted the markets you're talking about, I think that would be hugely accretive to performance. Agree, disagree?
Yeah, no, I would definitely agree. And as I said, last year was year one. We think 2026 will be year two of the non-US equity markets outperforming. I'd make the point to your kind of index point that here's one of the things that surprised me recently is that EM now has a bigger weight in ACWI than DM. So your EFA reference, if you actually look at
Say that
EFA
again, Jay.
versus
Say
EM,
that again. Hold on. Say that again.
yeah, EM,
Yeah.
emerging markets within ACWI, within the
Yep.
All Country World Index, has a bigger weight today than the EFA markets or DMXUS.
Really?
Yeah, it's not by a lot. It's like 11% EM, 10%
Right.
EFA. But the point being, EM has just subtly crept up above
Right.
EFA. And now I think, you're going to see the US. I mean, I think the way to think about it is the US is a source of cash.
Mm-hmm.
US equities are a source of cash
Funding short. Yeah.
for the rest of the world
Right.
for the foreseeable future. And so one of the things we didn't talk about, but which I think is very, very important, is the dollar.
Go.
And
Go.
the
Yep.
dollar we think has been weak. We think it will continue to be weak. And part of the reason for that is not only the erratic nature of the policymaking in the Trump administration, not only the massive overweight that non-US investors have in US assets. And by the way, it's not just equities, it's also treasuries and corporate credit, et cetera. But it's the growing focus of other countries starting to realize they need the money at home to fund their own build outs of AI, their
Right.
own defense budgets, their own dealing with climate. And so you're seeing it in Canada, you're seeing it in the UK, where they're pressuring their pensions to invest more domestically. And most recently, South Korea came up with a tax, changed their taxation to make it much more appealing for South Korean investors to invest at home versus abroad. I think it's not only the US being, kind of struggling under a Trump administration with its erratic policymaking, but it's also the needs of other countries and the recognition that the money is there. It's just simply being invested in the US. So Europe, for example, Europe exports something like 400 to 500 billion dollars of capital every year, right? That's the trade surplus that the Europeans have relative to the rest of the world, and they invest that money abroad, much of it in the United States. And yet, what are we doing with the Europeans? We're being about as belligerent and as unfriendly as one could possibly be to our supposed friends. And to me, it's not too much of a stretch to think about at the margin people saying, look, I've got enough here. I'm going to like either reduce my position a little bit or I'm going to reallocate new monies to,
Right.
opportunities at home. And so one of the basics for the tripolar world was each region's growing ability to self-finance, self-produce, and self-consume. And what are we seeing? We're seeing Czech arms makers floating the biggest defense IPO in history in Amsterdam. What are we seeing? We're seeing Chinese semiconductor companies going up 600%, being oversubscribed by 20 or 30 times as they raise capital in Hong Kong to develop their build
Mm-hmm.
outs in China. So the self-financing capacity that was the basis of the tripolar world thesis when we first constructed it 15 years ago is now manifesting itself in the day-to-day action in portfolio. So when we think of Japan, we think of a bear market in bonds. Where does yeah, and George, you'll know this better than anybody. Where does Mrs. Watanabe, where has
Yep.
she had her money the
Right.
last 10 years? In bonds. Where is it going to be? In stocks. The
Right.
Chinese had all their money in real estate. That has not worked, right? Then they went to structured credit to just get some yield. Now they're starting to go to equities. If China beats deflation and sustains growth, and companies start reporting profits, and the US says it's okay to invest back in China.
Jay, you touched on Japan, which is very important, the world's largest creditor nation. And for $50 in double jeopardy, I don't think too many people had it on their bingo card that JGB yields, 30-year, I don't know where it is today, 360 or whatever it is, the yen at 158 or wherever it is. Um, what do you think is going on? And why do you think that has not upset global capital markets the way many of us, myself included, if you told me the yen and the JGBs are going to be where they are, it would be a big hit on markets globally. So what's going on in Japan?
Yeah, I think it's very, very interesting. I think people have not updated again their views on Japan. Okay. So people have the view of Japan being a massively overly indebted place with no growth, with deflation, and so you can borrow real cheap and you can invest in higher yielding, the famous carry trade, which look, we did have a major shakeout a year or so ago, right? In that carry trade thesis. And I think that scared a lot of people. And I think that helps explain why the continued backup in rates has not resulted in more of that carry trade unwinding, creating havoc in other markets. But here, let me update people's priors on Japan. Japan's debt to GDP ratio peaked 5 years ago. Okay?
Oh, okay.
Where is the US debt to GDP ratio going?
It's
It is
going up
not
fast. It's
peaking.
going up
It
faster.
is going up like a
You'll be
rocket.
going up faster than the QQQ, the U.S. debt. Go on,
Yeah,
yeah.
exactly. Where is France's debt to GDP going?
New
Where
highs.
is
Some new
Germany's
highs.
debt to GDP going? Okay. The US, we touched on earlier, 7.9% budget deficit forecast for 2026, according to the IMF. Do you want to hazard a guess as to what the IMF forecast Japan's budget deficit to be in 2026?
It's lower, obviously, the way you're setting the question up.
Yes, 2%.
Two?
2,
Wait a minute. Wait a minute. Wait a minute. Wait a minute. Wait.
2%.
That's the entire budget deficit, or is that just the primary? That's crazy.
No, that is the budget deficit
Total
forecast.
deficit.
Yeah.
Plus, by the way, I know you alluded to it, but you didn't mention it. You're talking about the debt numbers on Japan. Maybe you're going to stealing your thunder, but it's like they owe like half the debt they owe to themselves. Like
Yeah, exactly.
yeah, yeah,
it's a
so if you look at
domestically
that,
owned
their
debt
debt level is
market.
much lower. It's much lower than people think. Yeah,
Yeah, well, yeah, the idea, yeah, there's not going to be, I mean, the way debt things blow up is when somebody stops buying. And
correct.
usually the folks who stop buying are foreigners because they get freaked out.
Right,
That's the whole emerging market, which again doesn't happen anymore because after 98, they stopped issuing, they stopped, buying, they stopped investing in dollar denominated stuff.
right,
So Japan there's no risk of a bond market blow up there. They have nominal growth, which now is running around 4%. So their interest rates are 2% on a 10-year JGB, and their nominal growth is 4%, which is why their
what's not
debt to
told? Yeah,
GDP is
what's not
going
planned?
down.
Yeah.
Okay?
Yeah.
So the problem is actually getting better. So I think that what's surprising to me is that the stock market is not really going up as much as I thought it would, with the currency being as weak as it is.
Yeah, because in dollar terms, it's a much more
Yeah.
uniform. It's agreed.
So that's a little bit of a surprise. And you look at, and this is one where it's kicked me because I've been a dollar bear. So I own EWJ. We have a very healthy position
Yeah,
in
yeah,
EWJ, but you could own DXJ, which is the
right.
hedged
The hedge
version.
one, exactly. Yep.
And the hedged version has done better because of the currency being weaker.
Sure.
But, when you look at fair value, the yen, fair value at the yen, some people think is around 100. So not to say that you're going to get there, but I think it's interesting to think about the potential for for the yen to strengthen. And again, you have a virtuous circle. And the last thing I'd just point out is that we all look at dollar yen. The thing to probably look at is won yen, right? Because where the yen is really cheap and where it has an impact is in Asia. So the yen relative to the Chinese yuan is also extremely cheap, which is why you see masses of Chinese tourists in Tokyo.
Right.
Because if for them it's in Asia, it's close, they can get there, and it's uber cheap, uber cheap. And
Hmm.
and, and so like I mean, Japan has got a number of positives to it. They're very exposed, kind of not the sexy semiconductor stuff, but almost everything else that's involved with AI. Japan has a role to play.
Right.
So in sensors and magnets and all that very fine manufacturing stuff, Japan is a player.
Hey,
Japan,
yeah, sorry, let me ask you on the yen. I mean, on currency because you are a dollar bear. So I remember we spoke early in the year last year. The currency once did a dirt nap. You appeared at our conference last June. Great call again by you. However, my dance card, I think yours kind of expected the dollar would continue to weaken. It certainly has against real assets, but with fiat currency, it's been the race to zero, the race to the bottom. The interesting thing is these commodities and the precious metals complex have all gone alight in the context of that's against the backdrop of a dollar which has been kind of stable against a lot of these other currencies for the last 6 9 months.
Yep.
If this is an interregnum and that resumes, talk about putting gasoline on the fire. I mean, to really get this stuff cooking. So yeah, we got a situation here, as they say. That's for sure. So Jay,
Well,
we could talk forever, but let's just a few things I wanted to touch on. We'd be remiss if we didn't include them. You started to talk about risks. We've highlighted what can go right, but it's always interesting to stress test yourself. What are you worried about? Okay, you and I spoke about this the other day a little bit. Could you just highlight, if we come back end of the year and you're not smiling, the risk asset markets got derailed or whatever. What are the things that you're keeping an eye on that could be the biggest source of upset for you?
I think what's really interesting is the prospect for tariffs to come back in the U.S. as a problem. And I know we're awaiting the Supreme Court ruling on tariffs, but my feeling is that if the Supreme Court strikes down the underlying structure for the bulk of tariffs that are currently been in place, the administration will pivot to other trade tariff capacity that it does have. So I think tariffs are going to continue. Excuse me. The thing that's interesting is two-sided. One is that we're about to embark on a restocking that will, by definition, include fully tariffed goods, which we've not yet done, right? Because 20 Q1 in 2025 was the stocking up pre-tariff, right?
Right.
And then we ran all that stock down through the rest of 2025, and now we're engaging in another restocking, which is going to include the fully tariffed goods, which I think will lead to higher goods prices. So that's
Mm-hmm.
one. So inflation, which, okay, the numbers came out the other day, 2.7, everybody thinks it's fine, but the reality is it's still way above 2, and no sign that it's going to be coming down significantly further. And risk, as I see it, as I just mentioned with the tariffs, of it being pushed back up. That then leads to a problem with the long bonds backing up, and that leads to a bigger problem with the growth stocks in the Mag 7. And that I think could be one of the catalysts for that traditional midterm cycle year decline, which tends to average 15 or so percent, and would be timed up pretty well for the middle of the year. Okay. The
Mm-hmm.
second part of that is what it means for the dollar, because as we shrink the trade deficit, we shrink the amount of money available to buy, to convert back into U.S. goods, right? When we're buying a lot from abroad, we send a lot of money
Right.
abroad, and the
Right.
folks abroad turn around and invest it
Mm-hmm.
in treasuries and other things. By definition, a smaller deficit, trade deficit, means fewer dollars to reinvest back into the United States. Again, potentially making it more problematic for the bond market. And so I do think that, we've been bearish bonds. I mean, in our GMA, we have not literally, George, and this is not an exaggeration, we have not had any US Treasury exposure in at least 3, probably 4 years. And keep in mind that our benchmark is 40% Barclays Agg,
Right. Right.
okay, in the GMA, the global multi-assets, 50% ACWI, 40% Barclays Agg, 10% Goldman Sachs commodity. So we have been massively underweight treasuries. And people say, oh, well, treasuries at 2025 had their best year in 5 years. They were up 6%.
Oh,
I'm like, okay. My copper miner position was up 60%. My gold miner position was
yeah.
up 100%.
Exactly.
I mean,
Exactly.
blah, blah, blah.
Yeah.
So, but I do think that that's the concern. And so we have been, as I suggested earlier, we at least have been using US tech as a source of cash.
Got it.
And at this point, we have a cloud position and we have a
Mm-hmm.
semiconductor position, and we're pretty much out of everything else. And the semis, to us, it's like the pick and shovel, right?
Yeah.
We think there's going to continue to be demand for compute, and there's going to be continued demand for semis. We made the point earlier about everyone's fixated on NVIDIA and the very high-end chips. The reality is that there's a dearth of the more basic, chips that are in everything these days. And so that those prices are going up dramatically.
Hmm.
And so the profitability of the semiconductor companies is likewise going up. And so we feel really comfortable, with the position in that part of it.
Okay. And then Jay, let's a couple more things, and we'll draw to a close. Energy. I think both you and I are positive.
I'm
And-
very positive.
yeah, and so I mean, we talked before about dollar going down, bond yields going up, trade deficit contracting. That's one risk. I don't know that I'm so, I'm not saying oil prices are going to skyrocket, but to the extent that lower oil prices have been a disinflationary impulse, and I believe you and I both believe that the preponderance of risk analysts for higher, not lower oil prices, that could kind of further muddy the waters with respect to bond prices. Just give us a stream of consciousness. What are you thinking about energy prices and energy stocks?
Well, I love the energy stocks. As I said, we have a big overweight in XLE and XES. Those are the two
Hmm.
positions we have. And so, that's a big, big overweight for us for this year. It's probably going into this year, it was probably the most attractive opportunity we saw because people were so bearish and you had so many opportunities for oil prices and oil stocks to break down, and they didn't. And that's always a really good tell for us is when the news is really bad and there's no
Yep.
reaction. It tells you that everybody who wants to sell is gone, and so there's nothing but upside. And so you see, the Wall Street hates and sees big risk there. We see opportunity because you have, Goldman and others have highlighted the speculative short position in oil is at close to records, if not at records. And so for us, that's a tremendous opportunity. I don't see oil, skyrocketing, but I do see my thesis has been that Wall Street had a 2026 Brent average price of about $52 a barrel. I think it's going to be north of 60. And so as I look at it, we're going to get continued reinforcement of Wall Street companies upping their forecasts over the course of the year, which will provide support for the oil companies. It's much like the miners, right? Our positions are in the copper miners, the gold miners, not gold or copper. And that's because those miners have leverage, right? When the price of the underlying gold goes up and their production costs are the same, their profitability explodes.
Right.
And that's what's happening in the mining sector. And we think there'll be a similar benefit, not to the same extent,
Sure.
because we don't think oil is going to do what
Right.
gold has done, but energy stocks will do very, very well.
Yeah, the way I like to look at it as well, it just echoes what you were saying. The spot commodity prices, they live in the present. The producers live in the future. So, you could argue, and I think it's the case, that these equities do not reflect the current spot prices. These companies start cranking out cash flows, because you look at the future prices, all right, it's going to be huge accretion to equity values. So I couldn't agree with that more. All right, Jay, compliment you, but I'm going to tease you. I'm told it's from a compliment. One of the greatest lines last year of all the interviews I did, that we had Michael Kramer on, and you were talking, you were saying your superpower. Let's not political. We're talking just pure financials. Leave politics to the side, right? So, from a market standpoint, you said one of your superpowers was to ignore what Trump was saying. Is that still important to you in terms of trying to stay clear minded about what's going on in markets, how to make money?
Yeah, absolutely. I mean, we wrote a piece about it called the Stoic Strategy, how to invest in the age of Trump. And we made a couple of points. One is that, the Stoics believed that one of the ways to forearm yourself against the future was to imagine all scenarios and thus fear none. And I think that is completely appropriate for how to think about investing in the age of Trump, right? Because as we've seen, and he's becoming he was more emboldened in year one of his second term than he was throughout his entire first term. And now, just in the last couple of weeks, I think we've gotten a sense that he is completely unbound. Really, literally completely
Oh, so
unbound.
I'll pile on. The other great line you had was even better than the other one. And I asked you about risks. It was in your last spring. You talked about. I have to go back and look at the tape. I can't quite remember if it was nothing's going to bankrupt the U.S., but he'd run the risk of bankrupting the U.S. He's a serial bankrupter. Okay, and when you start talking just a minute ago about 7.9% budget deficit according to the IMF for 26, leaving the humor out of it for a second, that's not the point. The serious point here is what that means for bond markets and real interest rates. Because when you have a credit downgrade, you expect the rate you're being charged to go higher. Bond markets have been very quiescent the last few months, and I firmly believe that at some point, just like you and I believe, at some point the market's already starting to change its view on energy prices. I think the idea that I think it's a consensus view on a lot of Wall Street firms. Oh, they're going to cut rates, and we got the magic disinflation, and true inflation is only at 1.9%, and 3.5% of the 10-year here we come. I think it's going to be completely the opposite. And I firmly believe that, sometime this year, 10-year yields are going to be meaningfully higher than they are right now. And so getting away from the humor in bankrupting the country or whatever, the impact of that fiscal profligacy has really not manifested itself in fixed income markets. And I don't know, what's your take on any of that?
Yeah, I would agree with that. And I think that that is the risk, right? That is the big risk that bond markets wake up one day and whether it's, the assault on the Fed or it's the 7.9% budget deficit or it's, foreign governments talking more openly about the need to invest at home versus abroad, any number of things, which is a problem. Just like we like to have two or three drivers to the bull case, right? And we try to enumerate them in Brazil and Spain, et cetera, and China, and in energy. When you can outline three or four risks to a position, you probably don't want to be big in that position.
Yeah, I know.
So,
Yeah,
so for us, we kind of feel like we're hedged somewhat by being, pretty significantly underweight U.S. equities versus the rest of the world. And today, again, is a perfect example. Right before we hopped on, I took a quick look. S&P was down 0.95% for the day. ACWI-X was up 0.15. EM was up 0.12. That's all you need to know, really.
and Jay, related
All
to
you
that
need to
last,
know.
last point on this bond thing, it almost seems to me it's preordained. It's almost guaranteed it's going to happen. I'll tell you why. Most of us, I'll speak for myself, and I certainly would speak for you. I don't want to speak for you, but these whole MMT guys are completely out to lunch. Spend as much money, it doesn't matter, deficits don't matter, da 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 da. So if I'm an MMT crazy, I could say, CJ, we're running these huge deficits. What's the problem? And as they always say in FinTwit, more, MOAR, more. You put on your football. Let's run the same play again until they stop us. Just jam it down their throats, right? So
Yeah.
it's almost like, and last time I checked, there's no constituency in DC to cut budget spending, right? So they just keep doing the same thing over and over again until they blow the whole system up. I mean, what would be your pushback to that?
Yeah, no, again, this is why we're making the case that fundamentally the macro outlook for EM is better than for DM. And DM, represented by the US. The US has been the gold standard with the premium valuation. And the case for that premium valuation is slipping away faster and faster, and yet it's still in place. And so our view is that that's going to change. The dollar's going to weaken, or the amount that you have to pay foreigners via interest rates will have to go up, or the multiple on which your equities trade will go down.
Yeah.
I think all of these things are going to happen
Jay, don't.
over the next 3 to 5 to 10 years, because I also think that you have China very clearly making a move for the future. In the US, sadly, in my view, retreating to the past, much
Yeah.
as it's retreating from a global role to a regional role. You have a situation where I think, and the rate of change is so great that, let's play it out a little bit. You have midterms coming up. Well, it looks like it's going to be a blue wave, which is one of the reasons why you're seeing the president and his team, go into overdrive on suggesting all these different things every day. It's a different thing coming out of the Trump administration because they see where things are headed. That means stagnation for 2 more years, no major policies of any kind. Then you have an election in 2028. Let's assume a Democrat wins. They'll spend a year or two undoing all the Trump things that have been done by executive order, which can be undone by a stroke of a pen because nothing has been passed through Congress. So that's 4 years away. And when you think about how much China has moved in the last 4 years, just look at how they depended on the U.S. consumer 4 or 5 years ago in a big way. And now they don't. So in 5 years, where China is going to be versus where the US is going to be, it's
Yeah.
like
No,
two
it's
cars
all the wrong direction.
going in opposite directions at full
100%.
speed.
100%. 100%. All right. So, Jay, just to wrap it up. So, you're bullish on risk assets, particularly EM, commodities.
And
Get your
thematics.
money out of the U.S. Dollars going down. I don't want to go into a big rant on it, but if people only knew how bullish you were in European banks as well, we didn't even talk about that. Okay, but we'll save that for next time.
Still am. Still
Still,
like them.
okay. So
Hey, George, on that front, real quick. So amazing on the European banks. They were up like 60% last year, okay, versus XLF up about 15%. And again, nobody talks about it. It's amazing to me.
no,
It's like almost, like unpatriotic to talk about how rest of the world is doing versus the US.
sure.
I mean, crazy as a global investor, right? Here's the data point that caught my eye this week. Deutsche Bank, one of the biggest banks in Europe, traded above book value, George, for the first time since 2008. It's one times book.
One times book.
Okay. Where JP Morgan is like, I don't know, two, three times book.
Yeah.
So the point is, and again, this is where I'd like to end from my point of
Sure.
view. The point is the opportunity set is not only broad, but it's still in the first or second innings.
Yep.
So,
Yep.
yeah, you're not buying at the low, but you're buying as things are breaking out. And when there are pullbacks, as there will be inevitably, and midterms, and if the US does have a pullback because,
Sure.
tariffs bite and bond vigilantes bite and the Mag 7 take a tumble, the rest of the world will come down a little bit too. I think like they did last April,
Mhm.
rest of the world will go down less. That was the tell in April. Rest of the world outperformed the US in that rapid sell-off. I think the same would happen again. But those are the buying opportunities because if EM macro is better than DM, if we have a new global growth model, if we have a China pushing to the future while the US retreats to the past, if you have the digital eating the physical, these are not things that are going to go away in a month or a
Sure.
quarter or a year. These are 3, 5, 7, 10 year kind of moves. And I think that's where we are. So, yes, it's been a good year. Last year was a good year. Yes, we're seeing the ball very clearly. Yes, at some point we're going to stop seeing things clearly, but I think we're in the very early stages of what's going to be an 6, 8, 10 year type of move.
Pelosky, you are on fire. Like, what was the game, the NBA thing with the players on fire? The little board, the electronic thing. You're on fire. This has been inspirational. Seriously,
Thank you.
I interview a lot of people. This is a keeper. I urge everyone to give a look to Jay's Substack. It's fantastic. Jay, we got to do this more often. This has been awesome. Thank you so much for your time, and we'll do this again before too long.
Great, George. Thanks to be with you. Thanks for the questions. Great convo as always.
Thanks, Jay.